In the years leading up to the 2008 financial crisis, a baffling anomaly took hold of global markets. Over 40,000 distinct mortgage-backed securities were awarded the highest possible stamp of financial safety, a AAA rating, by the world's leading credit rating agencies. To put that staggering figure into perspective, at that exact same moment in history, only a handful of sovereign nations and elite corporate titans held that identical level of supreme creditworthiness. Investors around the world bought trillions of dollars of these newly minted financial products, trusting the impenetrable shield of that three-letter grade. Yet, within a few short years, the underlying assets of these supposedly risk-free investments would evaporate, triggering a global financial meltdown. The question is not simply why the market collapsed, but how the very institutions designed to detect risk became the primary architects of its disguise. To understand this catastrophic failure, one must dismantle the basic architecture of the bond market. Credit rating agencies act as the ultimate gatekeepers of global capital. When a corporation, a municipality, or a sovereign government wants to borrow money, they issue bonds. Investors need a reliable, standardized metric to gauge the probability that they will be paid back. Agencies evaluate the borrower's financial health, historical performance, and cash reserves to assign a definitive letter grade. A prime rating signifies an ironclad guarantee of repayment, allowing the issuer to borrow at the lowest possible interest rates. Lower grades denote higher risk, demanding higher yields to compensate the investor for the increased danger of default. For decades, this system functioned as a straightforward, objective assessment of institutional debt. The foundation of this system, however, underwent a quiet but profound transformation long before the housing boom. Originally, investors paid for these ratings through annual subscriptions, ensuring the agencies worked directly for the people assuming the financial risk. But in the 1970s, the industry adopted an issuer pays model. Under this new paradigm, the entity creating and selling the financial product was the one paying the agency to rate it. This fundamental restructuring introduced a latent, deeply embedded conflict of interest into the heart of the financial system. The gatekeepers were no longer compensated by the travelers seeking safe passage, but by the toll operators whose revenue depended on heavy traffic. This misaligned incentive structure festered in the background until the dawn of the 21st century, when a new era of financial engineering supercharged the bond market. Wall Street banks discovered they could generate immense, unprecedented profits by purchasing thousands of individual loans, bundling them together, and selling slices of the resulting pool to institutional investors. The success of this securitization machine depended entirely on the cooperation of the credit rating agencies. If an investment bank could convince the major agencies to stamp the newly created bond with a prime grade, pension funds and global insurance companies, strictly mandated by law to hold only top-tier assets, would buy them without hesitation. The agencies, in turn, realized that rating these complex, structured finance products was vastly more lucrative than rating standard corporate bonds. The raw material feeding this lucrative assembly line soon shifted heavily toward the housing market, specifically subprime mortgages. These were home loans granted to borrowers with poor credit histories, minimal income documentation, and a high likelihood of default. Historically, such loans were considered far too risky for conservative institutional portfolios. But Wall Street required a constant, massive supply of debt to package into securities, and the traditional prime mortgage market was saturated. Lenders began aggressively pushing subprime products, utilizing adjustable rate structures that offered deceptively low initial payments before violently resetting to unaffordable levels, creating a ticking time bomb within the housing sector. To transform this highly toxic debt into institutional-grade investments, investment banks utilized a specific financial instrument known as collateralized debt obligations, or CDOs. A CDO is essentially a tiered waterfall of cash flows. The bundled mortgages sit at the top, and as homeowners make their monthly payments, the money cascades down through various tranches. The senior tranches at the top get paid first and absorb losses last, while the junior tranches at the bottom offer higher yields, but take the first hit if borrowers default. The mathematical models used by the banks argued that by pooling thousands of geographically diverse mortgages, the aggregate risk of the entire structure was effectively neutralized. It was here that the systemic failure of the rating agencies crystallized into pure financial alchemy. The agencies accepted the bank's flawed mathematical models almost without question. They treated the senior tranches of these CDOs as virtually impervious to loss, routinely assigning them the coveted AAA status. The proprietary formulas utilized by the agencies relied heavily on historical housing data from periods of steady economic growth, operating under the catastrophic assumption that real estate prices would continuously rise on a national scale. They failed to account for the reality that the underlying subprime loans were systematically designed to fail, or the crucial concept of correlation, that a nationwide housing downturn would cause simultaneous defaults across all geographic regions, instantly shattering the protective barriers of the CDO tranches. The illusion of safety generated by these pristine letter grades unleashed an unprecedented flood of capital. Trillions of dollars flowed from global investors into the American housing market, artificially inflating a massive asset bubble. The banks, eager to maintain their staggering profit margins, relentlessly pressured the rating agencies for favorable assessments. Because the issuer pays model allowed banks to shop around for the best grade, a perverse dynamic known as ratings shopping emerged. If one agency demanded a higher cushion of safe assets to grant a prime rating, the bank would simply take its lucrative business to a competitor with more lenient standards, triggering a dangerous race to the bottom in analytical rigor. Driven by the relentless pursuit of market share and surging corporate revenues, the agencies capitulated to Wall Street's demands. Executive leadership at these firms prioritized deal volume over accurate risk assessment. Internal communications, later exposed during congressional investigations, revealed a toxic culture where analysts who raised concerns about the rapidly deteriorating quality of the mortgage pools were routinely ignored, marginalized, or reassigned. The agencies functioned less as objective auditors and more as essential cogs in the securitization machine, rubber stamping increasingly complex and opaque derivatives to keep the exorbitant fees flowing. The very institutions tasked with illuminating risk had instead become its primary enablers. Beyond the traditional pension funds, the entire shadow banking system had become fatally dependent on these artificially inflated, corrupted ratings. In the repurchase agreement or repo market, financial institutions borrow massive amounts of cash on a short-term basis, using securities as collateral. To secure the lowest borrowing costs, that collateral had to carry a AAA rating. The newly minted CDOs provided a seemingly endless supply of this pristine collateral, allowing investment banks to leverage their balance sheets to astronomical levels. The ratings were not just investment guides, they were the structural, load-bearing pillars of the entire global short-term lending market. By late 2006, the underlying reality of the housing market began to violently diverge from the theoretical models. Interest rates rose, adjustable subprime mortgages reset, and defaults spiked at an alarming velocity. Yet the rating agencies maintained their top-tier grades on the vast majority of CDOs well into 2007. This delayed reaction created a surreal, suspended environment where the actual cash flows supporting the securities were disintegrating, but the official markers of their value remained perfectly intact. Institutional investors, relying blindly on the agencies, continued to hold these toxic assets, completely unaware that the foundation of their portfolios was already collapsing beneath them. The inevitable reckoning arrived with devastating speed. When the agencies finally acknowledged the depth of the crisis, they did not issue gradual warnings or measured adjustments. Instead, they initiated mass, synchronized downgrades. In a matter of months, Tens of thousands of mortgage-backed securities and CDOs were stripped of their prime status and plunged directly into junk territory. This sudden, violent reversal shattered the illusion of market liquidity. The financial models of major banks, insurance companies, and pension funds instantly imploded as strict regulations forced them to write down or sell off assets that no longer met their required credit criteria. The mass downgrades acted as the immediate explosive catalyst for the 2008 financial crisis. The abrupt realization that the world's premier financial institutions were holding billions in worthless, downgraded paper triggered a global panic. Credit markets froze entirely overnight. Banks stopped lending to one another, terrified by the hidden exposure lurking on their competitors' balance sheets. The collapse of Lehman Brothers and the near failure of the global insurance giant AIG were direct, unavoidable consequences of the sudden evaporation of value in these highly rated derivatives. The contagion spread rapidly from Wall Street to Main Street, erasing trillions in household wealth and sparking the most severe economic contraction since the Great Depression. When the dust settled and furious investors sought legal retribution, the rating agencies deployed a remarkably audacious legal defense. They argued in federal courts that their credit ratings were not objective guarantees of financial stability, but merely protected opinions under the First Amendment. By classifying their highly compensated, mathematically modeled risk assessments as a form of financial journalism, the agencies successfully shielded themselves from massive corporate liability. This legal maneuvering highlighted a profound systemic loophole. The institutions holding the power to dictate global capital flows bore almost no legal responsibility for the accuracy or the devastating consequences of their pronouncements. In the aftermath of the devastation, government inquiries sought to dissect the catastrophe and implement protective barriers. Investigations exposed the deep systemic rot within the credit rating industry, highlighting the disastrous consequences of the issuer pays model and the glaring lack of regulatory oversight. The Dodd-Frank Wall Street Reform and Consumer Protection Act of 2010 attempted to address these specific failures, introducing new, albeit limited, liabilities for agencies and mandating greater transparency in their internal methodologies. The legislation aimed to sever the cozy, highly profitable relationship between the banks creating the products and the supposedly independent analysts grading them. Despite these extensive regulatory efforts, the fundamental architecture of the system remains largely intact today. The major rating agencies still dominate the global market, maintaining an entrenched, highly profitable oligopoly. The issuer pays model, the very mechanism that generated the fatal conflict of interest, continues to be the undisputed industry standard. While the specific subprime instruments that triggered the 2008 collapse have largely faded from the market, the underlying incentive structure that prioritizes corporate revenue over objective risk assessment persists. The global economy's reliance on these centralized arbiters of creditworthiness remains a glaring structural vulnerability. The systemic failure of these institutions serves as a profound historical case study in the mechanics of financial distortion. It demonstrates exactly how perfectly rational corporate incentives, when misaligned with systemic stability, can engineer catastrophic outcomes on a global scale. The crisis was not simply a product of rogue traders, unpredictable market fluctuations, or random economic misfortune. It was a meticulously manufactured disaster, facilitated by a corrupted verification system that transformed high-risk debt into the illusion of absolute security. Understanding this hidden architecture is essential, for the vast matrix of global finance still relies heavily on the very same gatekeepers who once left the gates wide open.